Now we're going to talk to Prashant. So, good morning, Prashant. You just unmute yourself. We should be able to get going. There we go. Good morning.
Good morning, James. Good morning, everyone.
Now, I know we've got a number of disclaimers to work our way through first. So I'm going to leave them up on the screen here. And then, obviously, if you'd like to go back and have a look at them later, I'm not sure you'll be able to read them all in one go now. But obviously, they are important. And so, therefore, we do have to show them to you. And obviously, they'll be much easier to read on the recording. There we go. But I'm now going to hand over to Prashant for 5-10 minutes. If you just sort of walk us through what the fund is and what it's trying to do, please.
Certainly, James, and thank you, everyone. So I'm going to talk about Ashoka WhiteOak Emerging Market Strategy. In short, I'm going to call it AWM Fund, AWM Trust, or AWM Strategy. It provides access to, it's basically a multi-cap portfolio of emerging market equities, or otherwise equities that derive most of their value, or at least majority of their value, from emerging markets. Now, the most compelling reason, we believe, to invest in emerging markets is the alpha generation opportunity. As you would all agree, emerging markets remain under-researched compared to developed markets, and hence are more inefficient segments of the global equities market. So a good investment team can generate much higher alpha in emerging markets than in developed markets. And we at WhiteOak have had a fairly long track record now in India, and also considerable track record of extracting alpha in emerging markets more generally, particularly the mid and small cap segments, which again, universally, whether it's developed world or emerging world, mid and small cap segments have greater alpha potential if done correctly. It's not to say that large caps cannot generate alpha in emerging markets. They do as well. It's just that the magnitude is higher in mid and small cap. At WhiteOak, we have our own way of doing things, our investment approach based on our proprietary OpcoFinco Framework, which I'm going to elaborate somewhat more when we come to the philosophy aspect of the approach. It's a very disciplined approach that the team executes day in, day out, consistently, 365 days every year. The AWM Trust also has a fairly unique structure, and very well-designed structure. I would say best-in-class structure from an investor's perspective, where the manager or we ourselves are remunerated only if we generate alpha over the benchmark. Yeah, so there's a strong alignment on performance, and alpha measured over multi-year, 3-year time periods. Yeah, so solely a function of outperformance is what we get remunerated. Otherwise, we receive no fees. And when we receive based on alpha, we receive fees in the form of shares of the trust, where there are some lock-in arrangements on those as well, not to go in the details at this time. We also provide that the trust also provides an annual redemption facility to protect investors against sustained discounts. So if we now go to discussing more about on the next slide, how we do what we do. It's always been my strong belief that to generate sustained strong performance, it's prerequisite to have a strong focused investment culture, what we call performance first culture. Think of it, I often like to give the analogy of sports, in particular cricket, because investing in some ways is a form of sport or art, a serious form of sport or art. Yeah, so just like to win in any sport, you must have a sportsman's drive to excel and win the gold medal if you're competing at Olympics, or if you're participating in Cricket World Cup, which is around the corner later this year. Hopefully some of you would make it to India to watch that. You have to go that, participate in World Cup as any team with the intent and drive to win the cup. And that is the fundamental at the core of what we call our investment culture, a strong drive on the team to generate the highest returns for our investing clients compared to anyone else in the peer group, because that is the game or sport we've chosen as lifetime pursuit. And it is founded upon, or this culture rests upon, these four pillars, which are aligned with one another: team, philosophy, process, and portfolio construction. By alignment, I mean it's a bottom-up stock selection-based philosophy. To go with it, we have, in my biased view, the best team in the industry of stock pickers, implementing a time-tested process, at the core of which is our OpcoFinco framework, and all along, from a risk management perspective, maintaining a balanced portfolio that consciously avoids top-down macro bets, which introduce nothing but factor risk. And we aim to ensure that performance comes through stock selection. Now, if we move to discuss each of these elements briefly, a minute or two on each, so on the team, as you can see, it's the most well-resourced of teams in the industry, 43-member investment team. In the interest of time, I'll highlight three key aspects. First, it's the most well-resourced team of seasoned investors, with several of us, multiple of us having multiple cycles of experience, market cycles of experience, some of us going back to the 90s. Second, several members of the team have extensive global investing experience, including developed world as well as emerging markets. I myself have invested from 98 to 2006, some form or fashion, managed developed world equities or invested in or researched developed world equities. Third, we have a unique team within team structure, which is made possible by the luxury of resources that we've deployed, wherein every sector or subsector is covered by a team, sectoral team, rather than covered by individual on an exclusive basis, as is generally the practice in the industry. So each of these three, seasoned team, extensive global investing experience, and team within team structure, are either unique or uniquely strong on our team and collectively equip the team to generate the kind of returns they have historically delivered. The shared philosophy of the team on the next slide, if we were to look at, is that outsized returns are earned over time by investing in great businesses at attractive valuations. So two key elements are business and value. I know you probably hear the same from a lot of managers, but the devil lies in details and execution, like with everything else in life. What we consider as great business is one that has these attributes of superior returns on incremental capital, scalable, and well-managed, both in execution and governance. And these are born out of the fundamental value equation that value of a business is present value of future cash flows. When we find companies that possess these attributes, it's very important to value them logically and buy them and own them as long as there's substantial upside to fair value. So we are not from the school of thought that if you find a great business, you buy it regardless of valuation. That may have some merit in delivering average to above average returns over time, but our goal is not merely to be above average, but to try and beat the best performing managers out there. And in that respect, to that end, valuation discipline plays a very important role in adding the few extra points of performance. At that, I must note that we do not look at P multiples or EBITDA multiples or such at all. In our view, they are very distorted and misleading. What we focus on, first principles-based, cash flow-based approach, adapted to suit our investment philosophy, as explained in the next slide. It's an enhanced version or adapted version of DCF, what we call OpcoFinco Framework, where any company you can take for illustration purposes, Glaxo Pharma as an example. We'll split into two entities, Finco and Opco, where all the operating assets are housed under the Finco, and the Opco is the one where we assign the revenue and EBITDA from which it is deemed to pay an operating lease cost for use of plant machinery and a working capital cost, financing cost for use of working capital. After paying tax to the government, what is left in Opco is cash flows associated with excess return on invested capital. And the present value of such cash flows is nothing but the quantified value of excess ROIC in the business, which is what I highlighted in the previous slide as the first attribute that we look for. Whereas the FinCo is nothing but merely the value of the dumb capital or invested capital in the business, which by design earns only the cost of capital in this framework. So we basically, if you look at the bottom box, we split the value of the company into two very distinct and logically differently valued components. Enterprise value is equal to invested capital plus value of excess return on invested capital, which is the FinCo plus OpCo. And then when you rearrange the terms, you get the multiple price to excess ROIC multiple, which is what we use instead of PE multiple, which is nothing but the value of the excess ROIC divided by the cash flow of OpCo for any particular year. This is far superior and provides much more logical insights when comparing companies, because it adjusts for capital intensity of the business model as well as capital structure of the balance sheet, neither of which is done with PE multiples. Moving on to next slide then. The process where in brief, we start with casting the net very wide. There are about 3,000 companies with over $500 million market cap. In the trust, we also invest in companies below $500 million, but this is just here to give you a scale, example of scale of and scope of opportunities that is present to pick and choose from. Let's say about half of these companies have below average governance that are discarded or deprioritized. Of the remaining, let's say there are about 600 odd companies that also possess the other attributes that we are looking for besides good governance, the attributes that we talked about 2 slides prior. And of those, 100 odd companies make it into the portfolio, which also are attractively valued in addition to the attributes. We briefly covered the team, philosophy, and process. Let me now cover the portfolio construction as well. So the goal here is to maximize alpha on one hand and mitigate the volatility of that alpha in the interim on the other hand. The way we seek to achieve this dual objective is by allocating more capital to what we think or what we believe are alpha-rich segments of the market and less capital to alpha-deficient segments. What we mean by that is, if I were to illustrate on the next slide, universally, it is true, you all would agree, that the opportunity funnel looks like this, where large caps are more closely clustered around fair value, whereas mid and small caps are more dispersed. They are more inefficient segments of the market, as we were talking about earlier. Hence, we would have structurally higher allocation to mid and small cap compared to large cap. We are not suggesting that small caps in aggregate in the market would outperform large caps over time. No, that's not true. Ex ante, it's reasonable to expect all these market cap segments to deliver the same returns, but a good investment team can generate higher alpha from small and mid. Obviously, a poor investment team can destroy a lot more capital and alpha, and hence survivorship bias is so strong in this segment of the market. But obviously, we have a good, strong track record of generating alpha in this segment of the market, and hence continue to have a structural higher allocation in this segment. Similarly, there are other vectors that exist like market cap where there is an alpha gradient, even if there may not be the abundance of empirical evidence as in case of market cap. So on the next slide, you'll see some of these other vectors. I'm not going into the details of any of these, but we believe segments of the market which have disproportionately large companies with poor governance tend to have less alpha generation potential or prospects or opportunities. Now, in emerging markets context, often these are sectors like heavily regulated sectors, like utilities, commodities, and so on. Government-owned companies in general, be it public sector banking companies, the banking SOEs, or industrial SOEs, or so on. Also, in our view, less democratic countries or authoritarian regimes have weaker governance and weaker property rights, and hence weaker alpha potential than their democratic counterparts. Yeah. So not going in details unless there are questions to cover this, but please bear these in mind when we think of portfolio composition, which is on next slide. Higher allocation to sectors like consumer discretionary, technology, private sector financials. Almost all of our financials are private sector financials. Yeah, these are more alpha-rich segments of the market, as the proportion of better governed companies are far higher in these sectors compared to energy, utilities, telecoms, heavily regulated, these are all heavily regulated sectors, and commodities and all, which have several governance challenges. You can imagine, in energy, companies ranging from Petrobras, PetroChina, and so on, mostly government-owned companies also dominate these sectors that are heavily regulated. From a market cap perspective, bottom left-hand side, you'll see 70% compared to 70% in the benchmark, about 60% or so as we categorize it is in large cap. Over time, expected to be about 50-50. From a weights, regional or country weights perspective, it's better to look at the next slide. You'll see that, in the index compared to 78% in Asia or 30% in China plus HK, we have 65 and 21% respectively when viewed from a country of listing perspective. But we also own several developed market companies which derive bulk of their value from emerging markets, and several of these companies derive most of their value from China. When you take that into account, the China underweight is not as acute, in fact, is more or less in line with the benchmark, and same is case with Taiwan. Because in these cases, for example, in China, the problem is the geopolitical risk or the evolving political leadership in the country, whereas Chinese consumer still is there's nothing wrong there, and even with some growth slowdown from 5+%, we are still talking about one of the fastest growing economies for times to come. So if there are consumer discretionary companies in developed world, like the luxury names in France or otherwise, then those alpha opportunities we are very happy to tap, which also help us mitigate risks. Next slide, if we were to continue, shows that at an aggregate level, emerging markets, 60% are most democratic countries in the benchmark. Our allocation there is 78%, compared to 40% in least democratic countries in the benchmark. We are at around 21%, so about 18-19% over under. Next slide shows the same on SOEs. Compared to 19% in the benchmark, the portfolio has only 2% in SOEs, so 17% underweight in SOEs. Next slide shows then, as a consequence, there are certain, while at most time periods, especially longer time periods, we expect the trust to outperform, when certain combination plays out in the market, such as poor governed segment of the market outperforms better governed segment of the market, when sectors such as commodities, utilities, and all outperform the market, when SOEs globally outperform the market, or when authoritarian regimes outperform democratic regimes, when small and mid caps underperform the market. Obviously, all these are highly, highly unlikely to happen simultaneously, but if predominance of these were to perform very strongly, then there could be headwinds to the strategy, something to bear in mind. And then finally, if we move to the last couple of slides on the names, these are the top 15 names by absolute and active weights, a lot of names that would be familiar to investors and listeners. There are also, in the next slide, we provide some representative mid-cap names and small-cap names. They might not feature in the top 15, 20, 10 lists in the fact sheets and newsletters, but they're very, very important in their contribution over time to alpha generation, because there are sub 1% names or 1% plus names, but there are many dozens of these, and collectively make very important, in fact, our experience suggests a dominant contribution to alpha, and hence we've showed some of these as well in the portfolio. On next slide, then, we are coming up to the close. I'm going to skip the macro perspective on EM unless there are questions on these. But if we go towards the tail end, right in the end, to sum it up, in the very last slide, to sum it up, we have deployed extensive resources at WhiteOak and built one of the most well-resourced teams in the industry who have substantial experience of investing across EMs. While we don't predict the markets, but from a near-term valuations in EM are at multi-decade lows relative to developed world, and on many of the parameters like inflation, debt, and growth, they look far better poised than developed world. AWM Trust is designed to extract the alpha potential that exists across the market cap spectrum in EMs, particularly the mid and small cap. And it's presented with a best-in-class structure, as I highlighted earlier on, with zero management fee. We only make money when we add value to client portfolio. And so there is complete alignment in that sense of interest. And we have the confidence in bringing this to the market based on our past track record of generating strong alpha. So I went a couple minutes extra, or maybe a few, but I'll pause here, James, and turn it back.
Perfect. First one, we should probably look at just thinking about the structure. You've got an open-ended version of this and a closed-ended version of this. Is there much difference in the portfolios of the two?
There is some difference, just like those amongst the listeners. So James, as you might be familiar, is the difference between our Ashoka India Equity Trust and the Ashoka India UCITS. UCITS is a daily liquidity fund, so we have to be cognizant of liquidity. So same way you're in EM, UCITS, we have to be cognizant. And so some of the smallest of the market cap companies may not be suitable for UCITS, or if they're suitable, then suitable at a lower weight than what we can own in the trust vehicle, where we don't have any liquidity pressures. Secondly, UCITS by regulation cannot invest in unlisted equities. Not that we've invested in a private equity style, but the Ashoka India equity, as many investors and listeners might be familiar with, does benefit from the opportunities presented in what is called pre-IPO market in India, where we do invest a few months or even few days or weeks ahead of the IPO. We are uniquely positioned to leverage that opportunity and have historically done very well in that. And that also would be possible with the AWM Trust, as the regulations don't allow that in the UCITS structure.
Okay, thank you. I mean, liquidity is obviously a consideration. How small a small cap are you thinking? How far down do you go?
See, in Ashoka India Equity Trust, we've gone down to as low as 100 million at time to time from a market cap perspective. Obviously, we size the position in the portfolio to reflect the small market cap. So companies which are like $100 million, they're not, first of all, too many of those. Collectively, they might make up low single digit, call it 1 or 2% of the portfolio in the India equity, and the individual position size might be 25 to 50 basis points. So something similar is to be expected in the AWM Trust, where we might own, sub 500 million in the 100 to 500 million range companies from time to time. But collectively, I would expect that would be somewhere in the low to mid single digit %. And that those would be situations where we see extraordinary alpha potential, and we'll size the positions appropriately to reflect the market cap and liquidity risk.
One of the things that you do get with emerging markets is you can get quite big swings in and out of money, especially like when US allocators suddenly decide they want exposure to something. Is that something you'd ever try and game, or is it just noise in the background that you're just not focused on?
That's absolutely noise in the background, James. You have to be aware of what's going on, but there's no way, in our view, in our scheme of doing things, especially, there's no way of making any money out of that knowledge, if you will. And if at all there is any money to be made in terms of alpha, it's extremely small and extremely volatile. And you can't do both. You can't manage money that way, plus the way we manage. You have to pick one. It's like you can't be the best soccer player in the world as well as the best cricketing batsman in the world. You have to pick one. And we've chosen the better one, we believe, which provides for higher alpha generation and more consistent alpha generation.
Fair enough. One of the other considerations, I suppose, is sort of currency risk. Have you thought about hedging any part of this?
You see, when investors invest in EM, currency is part and parcel of that. I don't think there exists any EM fund or trust which hedges of any material size that on an ongoing basis would hedge currencies. It would not be worth doing so. It would be extremely expensive and introduce extreme volatility in alpha generation because the EM benchmark itself is unhedged for currency.
Yeah, fair enough. Now, in terms of the models you've got there, are we, just to clarify this, so you are modeling all of the great businesses, the sort of 600, 750. Is that true?
Yes, that's fair to say.
Because yeah, there's a question. So I suppose you need a big team to do that.
Yes, absolutely. It's all tied together. James. We have, first of all, the goal is to generate the highest alpha. If the goal is to generate highest alpha, you have to be able to explore small and mid cap opportunities. You're not going to be able to generate highest alpha if you don't explore mid and small caps. But to exploit the alpha potential in mid and small, you have to have a very strong team, not just by number, but by caliber as well. There's more high caliber work required in terms of quality as well as quantity or amount of time in researching a small cap name in any sector than a large cap name in the same sector. Because for large cap names, there are hundreds of sell side reports and ample off the shelf research available. Whereas in small cap, oftentimes you have to get your hands dirty to a much greater extent and dig deeper and deeper. And hence you need high caliber team members. And so we put that high caliber team to be able to exploit the alpha potential in mid and small so as to be able to have a shot at generating the highest alpha.
How important is it to visit these companies and meet the management?
It is important, and that is what the team's job is, to, when they're analyzing, to visit the team, to visit their locations, or depending on the kind of sector they are in. In certain sectors, it's more important to visit on site. In other sectors, more important to meet the management wherever it be, on site or in our offices or at conferences. And we do a combination of all these in due course of our research, not only meeting with the companies that we're investing in, but also their competitors and meeting with other participants in the ecosystem. Yeah, it may differ from company to company, the extent of how much it is desired, how much is done and is desirable, but you have to meet with sometimes the clients, the distributors, suppliers. Obviously, I mentioned peers, competitors, ex-employees sometimes can be very useful, provide some very useful insights about the culture at the company, the governance standards at the company, execution DNA of the company, and so
on. All right, let's find that. There we go. OpcoFinco. One question here. How do you work out what an appropriate discount rate is when you're doing these valuations?
A very good question, James. And we at the team do spend time discussing it. And not just this team, every team I've led, we have spent good amount of time. And any new member we hire on the team asks questions on how we go about using it. First of all, I believe CAPM or WAC is one of the most useless things that I learned in my financial courses. Okay, uh, the uh, the approach we use, which works best in the way we invest. Take any particular market. Let's take India as an example. It's the largest country in the portfolio. The way we think is over extended periods of time, looking forward, it's only reasonable to expect that the returns generated from the market, so let's say the Indian market, are going to be in line with nominal GDP growth of the country plus the dividend yield. If you look at the empirical evidence across the world, in developed world, be it US, Europe, or even in EMs, there's the last slide. If you were to go to the very last slide, but one before that, James, what this shows is over a shorter period of time, the returns. So this shows since the turn of the century. The leftmost top left corner shows that in the first decade, EM delivered 10% return, dollar terms. US was -1. The world delivered 0% return, Europe delivering 2. If you look at the bottom left, you'll see those were the earnings growth. EM had delivered 9% dollar earnings growth. That obviously everyone, if you recollect, loved EM at the end of first decade of this century. And next decade was the mirror image of sorts. US delivered 11, world delivered 7, EM delivered only 1% return. Europe is the only consistent mediocre performer, if you will, delivering 2 to 3% consistently. If you look at the 20 years combined, the third column, world delivered 4% return, US and EM both delivered 5. And if you look at the bottom, world delivered 5% earnings growth, US and EM delivered 6% earnings growth. Yeah. So over long, and if you were to look at the nominal GDP growth rate plus dividend yield underlying these markets, it would be similar, 5 to 6%. And 2 decades, all said and done, is only 2 decades. It's not the proverbial long term, but over extended periods of time, there's some logical underpinning to expect markets deliver nominal GDP plus dividend yield in local currency terms. And that is what we use as discount rate. So in India's example, real GDP growth about 6%, GDP deflator about 4% to 5%. That gives you a nominal GDP of 10 to 11%. Going forward, we expect 10 is a reasonable expectation. Add a percentage point of dividend yield. So 11% is the local currency discount rate that we use for the Indian market. And similarly, we compute for the other markets as well.
Okay, thank you. That's useful, I think. Now, a few questions on the portfolio. This one first. So I suppose the question really is how do you decide on position sizes? I mean, the specific question is why the 5% in TSMC, but just how do you decide on what the appropriate position size should be?
Certainly. So obviously the teams, sectoral teams present the ideas, they recommend certain positions, the rest of the team weighs in, and I obviously discuss at great length what should be the appropriate position sizing. Yeah. Now, position sizing is a function of a variety of aspects. First and foremost is the attractiveness of the business and the upside we see in the name. Then we also have to look at the market cap and liquidity of the companies. And remember, we are never going to have 100% of the portfolio in mid and small. We'll roughly have over time reasonable to expect 50% in large and 50% in mid and small. So the 50% odd that we'll have in large cap, their peer group, they'll be compared against relative opportunities within the large caps. So TSMC, Samsung, Hong Kong exchanges, these are the most attractive opportunities our team is finding at this point in time amongst the large caps, and hence they are sized accordingly in the portfolio. Similarly, if you were to look at next slide, which shows a lot of mid and small cap names, the 2-3 slides prior, when we saw the 3,000 names that are there, about $500 million or above, remember, amongst those 3,000 names, large caps are probably 100 to 200 names or 300 names or some such number. Yeah. Predominance, 2,500 plus names are mid and small cap. And they're the more inefficient segment. So our team is able to find a lot, many more ideas in mid and small. And we have to position size the mid and small cap names relative to the opportunity set in mid and small. And so since there is abundance of opportunities for high alpha generation that we find here, we don't need to take a 4-5% position size in these small and mid names. We can take 50 basis points, 100 basis points, even less in these. That mitigates the liquidity risk as well, and yet preserves very high alpha potential. So if that makes sense, James, I would say that's how the position sizes in large caps tend to be much larger. Mid and small cap tends to be less so because of the different opportunity sets.
That makes sense to me. There's a specific question here. Why hold both Process and Naspers? Because they're both a play on Tencent, I guess.
Certainly. So certain times there is greater discount in Naspers. At other times there's greater discount in Process. So we just, when we add the marginal dollar, the one that has greater discount at that time, we add to that. Obviously, on a day-to-day basis, we don't completely go out and in these names, but the new dollar, the marginal dollar, goes to the one that is at greater discount.
Fair enough, that makes sense. And Hong Kong exchanges, the question here is there a risk around sort of the Chinese authoritarianism for that stock in particular?
No, not, I would say not for that stock in particular. There's general risk of, with any country. Look, when you invest in emerging markets, you have to take the risks along with the emerging markets. The last 20 years returns that we showed at 6% are returns generated after several of the risk events have played out negatively. Yeah. In emerging markets. So there would be those risks with individual emerging markets, and Hong Kong Exchange would not safeguard you from that risk necessarily. Having said that, we believe that the business of Hong Kong Exchange, as the business of exchanges are around the world, is one of the most transparent business models. Unlike, let's say, a SOE, Chinese SOE bank, where we don't know what we are buying. I don't even believe that it's a corporate, a Chinese SOE bank, maybe in our view, just an extension of the Chinese government. So we don't have investments in SOE banks, but in Hong Kong Exchange, it's very transparent. I mean, you have the exchange volumes, you have the exchange fees, and they all translate at the end of the day. 100% of the earnings translate into cash flows. I'm not saying that there's no risk. There's risk in every name, the China risk, if you will, in any Chinese name. But this is as far removed from some of those risks as you can find in China.
Okay, thank you. There's lots of names on here. I mean, there are very few that I know. I suppose this is the fun bit, really. What's the kind of turnover like on the portfolio? Are these things that you buy and hold for a long time?
Certainly. So if I were to think back of my professional investing life, there are names that I probably have. So professional investing life goes back to 98, so coming up to 25 years. But obviously in emerging markets, including India, I've been investing since 2007. There'll be probably some names you'll find that I've owned pretty much throughout from 2006 till now. And yet other names which have been owned for far lesser period. Remember, buy and hold is not something that we necessarily in itself believe is a winning strategy. We don't see the beauty in buy and hold. If something you buy with a 50% upside and that goes within a short period of time, goes up 100% and there's no more upside left, we don't see the beauty in holding it for the sake of holding it. So we do trim or exit. We are valuation sensitive and we would trim and exit if there is no upside or very limited upside left. Having said all this, the average holding period, in my experience, for us has been over the long period, a little over 3 years. 3 years and a quarter, you can say it. About 30% name turnover has been the historical average over time. Weight turnover is somewhat higher because of the adds and trims, which may not result in exit or entry of new names, existing names. So name turnover is a little over 30%.
Okay. I suppose just on the size of the fund, I mean, it was great to see you persevere with this, I suppose, given the negatives around and the perennial problem we have in the sector of trying to persuade people to buy stuff that's cheap rather than stuff that's been going up for the last 3 years. How do you, what's your sort of ambition in terms of growing the fund? Will you just keep sort of dripping stock out while it's trading at a premium? Is there a size that you'd like it to get to?
Certainly. So if I were to compare it with the Ashoka India Trust, which we launched more than 5 years ago, 2018, it wasn't an easy time to launch India Fund either. We raised 46 million pounds at the time. But my view was, let's just get the performance clock started. Once you have performance, I've seen it a number of times in my career. Clients would trust you with their capital. If you can demonstrate performance over time in a logical manner, explain the performance, clients generally respect that and would put their confidence, repose their confidence in your team. And we've seen the India Trust growing from 46 million pounds to 250 million pounds plus. A lot of it is obviously performance as well, but a lot of it is additional tap issuances and the fact that it has almost always traded at a tiny, small premium, which is rare in the trust industry and even more so in the India trust space. Similarly, here, James, our expectation is, my expectation from the team is that they'll deliver performance. We have the best-in-class structure, and if we deliver that, then clients, I'm very hopeful that they would show their confidence in us over time as we demonstrate performance.
Good, thank you. Do you use gearing within the structure?
We don't take market calls, not our style. As I was sharing earlier, we try to minimize factor risk and focus on stock specific. So you should expect that the fund would be close to 100% invested at all times, but not take gearing. Would neither be, in big amount of cash, nor take much. We might do something tactical. For when I say, I hesitate to say tactical because it would sound risky, but if you think of net gearing, there would be almost never, is my expectation. Again, I don't want to bound myself at this time, but if you look at Ashoka India Trust, it's never had over the last 5 years any gearing. Same is reasonable to expect with the MM Trust as well.
Okay. And I've got to ask you this question because somebody's asked it. Who's going to win the Cricket World Cup?
No points for guessing it right.
Good. Fair enough. Thank you very much indeed. I think we've covered an awful lot of ground. And good luck with it. And
I hope to see some of you in the audience in person in India to see the Indian team lift the cup.
Thank you. All right then.
I saw it, by the way. I was there at Lord's and really fortunate to be there at Lord's to see England win the last World Cup. What a match it was.
Cool. All right. Thank you very much, Prashant. And we shall talk to you again in a year or so. But
thank you much, James. Thank you so much. And thank you all for listening.
Good. We're back next week talking to Dean Orico for Middlefield Canadian Income. And as we mentioned before, we've got a full lineup. Actually, we've got something in for the 6th of October. I didn't put that in, but I shall do that next time. So thank you very much for tuning in today. Have a good weekend, and we'll see you next week.